Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Planner. Now, the next 30 minutes, we will be telling you where you should be investing your money in 2013. Dr. Renu Pothen, researcher of Fund Supermart, joins us in our Mumbai studios. Thanks, Renu, for joining in this evening. Renu, we're at the start of a brand new year. There's so much of optimism surrounding the equity markets. I mean, I don't even think we started 2012 with such a bang. People are talking about very aggressive targets. It seems like India is shining once again with regard to the equity markets, at least. Given the kind of scenario that we're seeing globally and domestically, equities are seeming like a hot spot to be invested in. If somebody is looking at starting off their investments in 2013, what in your opinion are good funds for this year?
Okay, as far as 2013 is concerned, we also as positive on equities, but we've been bullish on equities for a long time. Even when everyone took in pessimistic view, we've been even then suggesting all our investors to take an exposure into equities. And as far as 2013 is concerned, some of the picks that we're recommending in some of the categories are like in the mid-cap space, we have some good funds like IDFC Sterling Equity Fund. Relatively new fund, but it's been able to been an outperformer since its inception. Then we have HDFC Mid-Cap Opportunities Fund that we've been recommending for some time. A new entrant that we are suggesting to investors this year is the SBI's Emerging Business Fund, managed by R. Srinivasan. This fund has been showing good prospects. So that's these are the three funds that you can look from the mid-cap space. Then normally we have other funds in the large cap and the multi-cap categories. Whatever we recommended in 2012, the same kind of funds we're recommending this year as well. Like in the large cap space, we continue to be bullish in ICICI's Focus Blue Chip Fund or DSP's Top 100. In the multi-cap space, we have UTI's Opportunities Fund or IDFC Premier Equity Fund. So these are some of the recommendations as far as the diversified categories are concerned. On the sectoral front, that is for those investors who are looking, who are ready to take some risk and who wants to take an exposure into sectoral funds, we're betting on infrastructure and banking. We've been doing that for the last 2 years as well when there's been a lot of negative news on that side. Our preferred funds in these two sectors. On infrastructure, we are positive on Pine Bridge Infrastructure and Economic Reform Fund and ICICI's Infrastructure Fund. And in the banking space, we're positive on the Reliance banking space.
I just want to discuss this with you and help us understand this. Given the kind of optimism that is surrounding the equities market right now, a lot of people might get ahead of themselves and start betting big on mid-caps and sectoral funds because those perform well in a bull run more often than not. How should an investor with average risk profile be looking at his investment or asset allocation across equities specifically? So what is the kind of exposure one should have in diversified funds? How much should one have in sectoral funds? What should one be doing with mid-cap funds? I mean, there's no reason to go overweight on either one, is there?
No, there's no reason to go overweight. That's what I've been saying, that when we started seeing equities when last year or even before that, I mean when equities were not performing well, okay, we have been telling investors to start taking an exposure then only. But now when they have actually seen the performance, we see all investors getting excited. They want to enter at these levels. So I would suggest them to, go in a staggered way as far as investments are concerned. If you're asking me about the portfolio kind of allocation that we're looking at, I would say that currently in the environment, I would suggest 70-30 kind of investments for equity and debt. So in the equities, you can give around 20% to your large caps, and the rest you can diversify between your sectoral and mid-caps and multi-caps. So that's the risky kind of categories out of the 70. In the 30, as far as debt funds are concerned, you can either go for the duration funds or the dynamic bond funds, and taking the call depending upon the view on interest rates.
Renu, I do take your point where you need to start sort of getting a lot more aggressive with your equities portfolio because there's so much buoyancy in the markets. Up until 2012, it was defensive that led the rally. It was defensive funds such as an FMCG or a pharma specific or even a banking fund are the ones that outperformed. Coming into 2013, a lot of people are talking about infrastructure, like you already said. Real estate, for that matter, is also looking quite hot. What happens to individuals who've already invested in funds that were very, very hot in 2012? Do they sort of reallocate their money? Do they exit maybe a pharma fund or an FMCG fund and put that money off into maybe an infrastructure fund?
I think that, yeah, those who've made money and in these sectoral funds, I mean, if they want to book profits, they definitely can do so. Otherwise, they can continue to stay invested, because it's not that these sectors are not going to do well in 2013 because an infrastructure is going to do well. So I would suggest that if you have kept a time horizon in mind, definitely you can continue to hold on to them. There's nothing to shift from there to an infrastructure, because every sector has its own, sectors are definitely cyclical, so you need to take a call depending on that.
I know they say that a long-term investor is the one who's best suited to invest in equities and diversified portfolios, make money for you when you're invested for the long term. But if it's a cyclical fund, or it's a thematic fund, or a sectoral fund for that matter, they do not do well consistently over a period of 5 years. It'll be a 1 year will be great, maybe 2013 might be great for infrastructure funds, so it might not be as great in 2014. So how does an investor go about doing that? Because on one hand, you've got to stay invested for the long term, but on the other hand, sectoral funds are very sort of, very sort of, I wouldn't say flaky, but then they're obviously a lot more short term as opposed to a 5-year time horizon.
Exactly, I agree with you.
It's the flavor of the season, if I can call it that.
Yeah. Right now, if you see, there's a lot of hype around infrastructure as a sector. I mean, I think in 2010, 2011, when I was talking at that time about infrastructure, that was a contrarian view that we were taking, because the entire industry was against that kind of a sector. But today, everyone is in favor of the sector. As you rightly said, infra has not performed for the last 2 years. People are wondering what they're supposed to do. I would say that they need to wait and see, that investment time horizon has to be there for a sector to perform. So you'll have to give infrastructure 5 or 6 years to actually perform.
So as long as you give a diversified portfolio, so you give it as much time, even if it is the flavor of the season or flavor of the year.
It's not like you enter a fund, a sectoral fund, and then you make the profit and you leave.
You don't do that, even if it is a sectoral fund. Also, what are the kind of returns one can anticipate or expect in terms of a diversified fund, a mid-cap fund, and a sectoral fund, realistically?
I wouldn't like to comment on the returns, because
approximately, because a lot of people get very aggressive. So if your equities are returning about 22%, which is what we did in 2012, and of course people are talking about a 25% plus sort of returns in 2013, would mutual funds perform almost in line? Would you get market returns? Would you get better returns than what the market is giving?
I wouldn't like to comment on that, on the returns part.
Okay, just moving on from of course, equity funds, or rather domestic funds. What happens to global funds? How hot are those looking?
Okay, again, for global funds also, we've been very positive on the China fund since the last 2 years. As you know, China has not been performing well at all, and domestic investors are definitely not very happy with the kind of performance that these funds have given. But even now, we are bullish in the China markets and the Asian markets, and we are telling investors to hold on patiently, and we are expecting 2013 to be a little bit good for the global markets. As far as China is concerned, some of the numbers that are coming out are definitely better, so I think the fund should perform also. Asian markets are also looking good. We are expecting an export rebound in Asian markets. So if you take all that into perspective, 2013 should be a good year for
China.
Yeah.
What about the currency risk involved? Is that taken into account as well? Or do you make these investments through a feeder fund?
We make these investments into the feeder fund, but the investor has to also bear in mind that there will be a currency risk in these kind of funds.
So there is that fluctuation that you've got to keep in mind. Well, apart from these global funds, what about commodity funds? How good are commodity funds expected to do in 2013? Anything that you'll have on your recommended list?
No, we don't have any commodity funds.
Nothing at all.
Nothing at all.
Right, so we've already talked about equities. What about debt? I mean, there is a general expectation. We saw that inflation number this week. We've seen IIP last week. All those numbers are indicating to a rate cut on the 29th of Jan. It might not be as aggressive as 75 basis points or 100 basis points, as much as bankers would love to see that. Given the fact that it's going to be a lower interest rate regime from here on, how attractive are debt funds?
Okay. As far as debt funds are concerned, as you rightly said, there is a clear expectations. The market is expecting rates to go down, and RBI has also made it very clear that inflation is going to go down, and seeing the positive vibes from the government side in terms of the reforms that they've initiated, like after a long time, it's surely it's very sure that the rates are going to be cut. How much is something that I don't think we can predict. But as far as the funds are concerned, I would suggest investors to start taking exposures into income funds. Okay, some of our top picks this year, that's a long duration funds. Some of the top picks this year are Canada Income.
This is despite the fact that rates are going to be softening going ahead.
Yeah.
So they should be looking to block those funds before the rates are cut.
Yeah, exactly.
So the next couple of weeks is when most people should be getting their fixed income funds invested in. And which ones did you say you recommend for 2013?
We are saying for conservative investors, you can look at Canada Robeco's income fund, and on the aggressive side, we can look at Templeton's income builder account fund.
Anything else that you're recommending, short term, medium term in nature?
Short term we still find positive, and as I've told last time also, on the short term side, if investors still want to take an exposure, they can, like maybe for the next 3 to 6 months, because long term I'm looking at like 1 year, 1+ years.
Yeah.
So on the short term side, our preferred investments are the UTI short term fund, or Templeton short term fund, or the PineBridge short term fund, any of them.
And would you recommend investors to look at short term fixed income funds, or it's preferable not to look at those?
If the investment horizon, if the investment horizon is like 3 months or 3 to 6, they still can continue to look at short-term funds.
What about investors looking to lock in their FDs? Is it a good time to do that ASAP? Or would you wait it out? So if somebody is looking to get an FD going, should they be doing it immediately, or should they wait it out for the next couple of weeks?
I think they should do it immediately.
Because this is probably the best time to get that rate that you're looking for, given that. Right, that's the advice coming in, all your investment advice for 2013. Renu telling us where you should be betting on and what sectors, what funds look attractive this year. We'll take a break on that, and we'll come back and take some of your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. It's now time for us to take up all your financial planning queries.
Investment Ladder, presented by BSC, Investors Protection Fund.
Renu, we've got a query coming from Sai Kiran, and he says, should he invest in a bank's tax-saving deposit or an ELSS scheme?
Okay.
It's a very basic and very plain vanilla question.
Yeah, I think that if he's a conservative investor, then he can look at the bank deposits. There the lock-in period is around 5 years, and the returns are like assured. Yeah. So there's no, you need not take any tension on that side. But as far as ELSS is concerned, that's one of the product where the investments is made into the equity market. So when I say equity markets, you can expect that there'll be volatility definitely. So if you're a risk if you have the risk appetite, then you should go for the ELSS schemes. Lock-in period is definitely lesser than bank deposits because it's only 3 years. But please remember, it's highly volatile and the returns are not assured like a bank deposit.
But they both serve the same purpose, right? I mean, they both help. They're both as efficient in terms of tax saving.
Exactly. But in the ELSS, you don't have. At maturity also, the capital gains is not taxed.
In ELSS.
Yeah. Right. But for FD, your interest earned will be taxed.
So ELSS are more tax efficient.
Exactly.
And there's a lock-in period is shorter.
Yeah.
It just takes away. It's just a lot more volatile.
Yeah.
Right. So that's the advice coming for side. Depending how risk averse you are, you've got to make your pick between a bank's tax saving deposit or an ELSS. But remember, your bank's tax saving deposit will have a lock-in period of 5 years, while ELSS has a lock-in period of only 3 years, but comes with a lot more volatility as it invests in equity markets. Renu, we've got another query from Anil Shukla, and he says his father has retired recently. He's received 30 lakh rupees upon retirement and wishes to invest this money. Where and how should he invest this amount?
Okay, as far as this father's retirement corpus is concerned, I would say that if you're looking at the mutual fund space, I'll have just one product to give him, that is a monthly income plans.
Right.
So monthly income plans are those plans where about 15 to 20% they would invest in equities, and the rest would be invested into the debt markets. So yeah, stability of returns and the upside potential that's provided by the equities is definitely there. But if you don't want to get that upside, then maybe this is not a good option. There's no guarantee on the returns or on the monthly regular income. One of the funds that we have liked in this space has been Reliance Monthly Income Plan. It invests 20% into equities and the rest into debt, and in the debt it takes a good exposure into corporate debt and GSEC. But one thing that we have observed since 2010, this fund has not missed out a dividend even once. So the monthly income has been paid to the investor every there's not every month actually. So this is one of the few funds in the industry who's been able to do that. Otherwise, if you don't want the equity, if you don't want to take any risk, then you'll have to consider something outside the mutual fund space, maybe a senior citizen savings schemes from the post office, where each account, I mean, you can open an account either jointly or in your own name, and there you'll have to put in 15 lakhs, that's the maximum that you can invest.
Also, I mean, I'm just going to broaden this discussion into other asset classes. 30 lakhs is not a small amount of money. Do you think investing in real estate, which can of course generate a monthly income thereon, could be an option?
That could be an option, but I think this is a retirement corpus.
But then equities would not be ideal for that, would they?
No, they wouldn't be ideal. So that's why I said a monthly income plan is also something where, it's 20% into equity and the rest is into debt. It's a little more safer than a real estate.
Also, should he be looking to invest the 30 lakh rupees in a lump sum investment, or should this be done staggered, because that obviously gets you the best returns in the long term?
I'm with you on that. I mean, he should do that in a staggered manner.
How do you recommend him to do that? Should that be done through an STP? What's the best way? Because he's already got that 30 lakh rupees in cash, and ideal money is...
Yeah, if it's a monthly income, then he can, if he's looking at the mutual fund space, then he can do that STP. But if it's a post office account, then he'll have to put 15 lakhs in his name. And the rest 15 lakhs, maybe he'll have to, put it in his wife's name, because one account can have only maximum 15 lakhs.
Okay, so that's depending on what Anil chooses, or Anil's father chooses to do. Well, we'll take a break on that, and we'll come back and take some more queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. We've got a query from Satyam Sharma. He's 28 years old, and for the past year and a half, he's been investing via SIPs of ₹1,000 each in HDFC Top 200, HDFC Equity, HDFC Mid Cap Opportunities, and Birla Sunlight Dividend Yield Plus. Is his portfolio good enough?
If you look at the portfolio as such, there's no problem, because all the funds that he's chosen are some of the best performers in the respective categories. But my only concern for this portfolio is that, it's 75% or more is into just one fund house. I would call that a concentration risk. And mind you, two of the funds are managed by the same fund manager as well. So I would suggest that maybe he can make a revamp in this portfolio. There's no concerns as such, but it's always nice to diversify into, other fund houses as well, so that you can reduce the concentration risk that can come out. In the large cap space, instead of the top 200, I would recommend an ICICI's Focus Blue Chip, and in the multi-cap space, instead of the HDFC Equity Fund, he can look at UTI Opportunities Fund, and both are the best performers in the categories.
He's quite young. He's 28 years old, and like we talked about in our previous segment, sectoral funds are quite hot for 2013. Do you recommend any sectoral funds in his portfolio, any sort of rejigging at all? And given that I'm assuming he's young, so his risk profile would be fairly...
if he's ready to take that kind of risk, I would definitely suggest sectoral funds.
Any specific funds that you think he could
As I told you, either he can go for the banking fund or the infrastructure fund, any of them.
Instead of the HDFC Top 200, it could be an option. Right, moving on, we've got a query from Rishabh Goyal. He's 30 years old and he plans to invest via SIP of 2,000 each in HDFC Mid Cap Opportunities, ICICI Prudential Focus Blue Chip Equity, IDFC Premier Equity Plan A, and SPI Magnum Emerging Business. His goal is to generate wealth in the long term. He is looking to invest for the next 15 to 20 years. He understands that this portfolio of funds would have above average risk associated with it. What would you recommend?
I think all the funds that he's chosen for his portfolio are the best in the category, so I don't expect him to revamp them. Above average risk, definitely, because there's a good exposure into mid and multi-cap. So, but As long as you're ready to take risk, there's no concern in this portfolio.
Do you think he should sort of reduce that risk by, increasing his exposure on diversified funds? Because I'm assuming he's a first-time investor from the sound of it.
I think there's no need because he's quite young, so...
And he's got about 20 years on hand.
Yeah.
Well, Rishabh, so I guess you're on the right track. The funds look good as per Dr. Renu. Well, we've got one more query. I think we'll try and squeeze this one in as well. And this comes in from Shankar. He says, how are non-convertible debentures taxed? Should they be sold before maturity in the secondary market with STT paid to derive indexation benefits?
Okay. As far as non-convertible debentures are concerned, the taxation is that if you hold it till maturity, your income will be clubbed to your normal income and taxed at the marginal rate. If you're planning to sell the NCD before 1 year, short-term capital gains will be
so there's no indexation benefits.
There's no indexation
NCDs,
benefits, right? Because long-term capital gains is 10.3% without indexation. Right. And he's asked whether STT is applicable. It's not applicable for NCDs.
Okay, so just to recap that, if he holds it up until maturity, the interest is clubbed with his income and taxed at the marginal rate. What would that be?
It depends on in which tax slab
he's falling in. Okay, and there is no indexation benefits and there is no STT either that applies to NCDs.
Investment Ladder, presented by BSC, Investors Protection Fund.
That's the advice coming in for you, and I guess with that we ran out of time as well. It's a wrap on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.